Good afternoon, everyone, and welcome to our second episode. Today, we're going to delve into how the various stock markets in the world were actually created. So, in the 1600s, the Dutch East India Company was running around the world, um, hundreds of ships trading commodities, buying gold, spices, different materials, and fabrics and so forth, and bringing them back to Europe and trading. The issue with having so many ships is that it's very capital intensive. So the owners of the company began going around to the shipyards and the coffee shops and restaurants and so forth and selling shares in the company. So what happened was that as the company continued to earn revenues, the share prices increased and more people became interested in purchasing shares. And this allowed the Dutch East India Company to expand their operation, therefore growing more profits, making the shares more attractive, and selling more shares. As you can see, it compounds on itself. So the practice of selling shares became very lucrative. And since then, companies have been selling up ownership interest or shares, stock in the company, in rate revenues, and build the business. A lot of businesses are capital intensive. Consider Apple. Consider how much money it takes to produce millions upon millions of phones, laptops, iWatches in order to distribute on your product debut day. You haven't received any revenues from these items, although you plan on selling millions upon millions of them, and the revenues will come. Right now, you need investment money in order to produce these items. So Apple sells shares in the company and uses that money to produce the products, which they make a profit on, and makes the company's shares look more attractive to the investor. And like I said, it just keeps growing on itself until the investor finds a reason to believe that their investment isn't safe, or that the company is going in a different direction, or is going to not be as profitable in the future as it was in the past. So the stock market is based on a lot of perceptions of what's going to happen compared to what has happened. Um, So the stock market and this industry of the stock market has grown into a juggernaut. You can go to school to learn how to trade stock, to become a financial analyst, a broker. There are multiple gurus and furus on YouTube and Facebook and so forth who are telling you this, that, and the other thing. You have people developing algorithms to trade for you. And a lot of times, it works a couple times, and then it doesn't work anymore because the market is always changing. So basically, what the stock market is a place where individuals like myself and you can go and purchase interest in these companies. You have the New York Stock Exchange, the NASDAQ, which is mostly technology companies. You have the Chicago Board of Trade, which is a commodities trading platform. You have the FTSE in Europe. You have the Hang Seng, the Chinese Stock Exchange. Jamaica, at one point a couple of years ago, was the best performing stock exchange on the planet for a little itty bitty country. So that is what the stock market is, where you can go, you can buy ownership interest in a company, and then hope that the company's assets and revenues and growth increases over the years, thereby bringing your stock price with it, earning you a profit. So that's the basic of the stock market. Um, Today's markets, like everything else, have evolved and are mainly electronic. Right now, you grab your phone, you can download Robinhood, Moo, TD Ameritrade, uh, Templeton, uh, Schwab, Stash, and there are links below for you to go ahead and get some free stock by signing up to these platforms. And also, I'll get a free stock if you sign up. So that's also wonderful. Me personally, I have each of my children has a stock trading account where there are funds deposited monthly, and those funds go into an aggressive trading fund, and a portion of the funds I personally choose stocks that I think are going to perform well over the next 18 years because these kids are young. So you can trade 24/7 depending on where you are, like QQQ and the SPY index, which are all things that we're going to get into. Those funds trade 24/7. So the stock market has turned into something that is very attainable, very accessible, and can be used as a vehicle to extremely increase your personal income on a daily, weekly, monthly basis, depending on what type of trading you do. In the stock market that we're talking about, you have folks who purchase stocks as investments and they sit for years. For instance, you could look up what you if you had invested $1,000 into Apple when the company was founded, how many millions of dollars that would be worth right now. And I am not joking. I'm not exaggerating either. It's quite substantial. Um, so a stock like Apple, you have a situation where these stocks run up, the prices get really high, and then the company does a stock split. When they do a stock split, for instance, say you have one share of Apple, it's at $500, and they do a 5-for-1 stock split. Now you have 5 shares of Apple. They're worth $100 a piece, but maybe in a year or two they'll be worth $500 a piece. So the $500 you initially invested is now worth $2,500 because of the stock split. And these things happen on a regular basis. Google recently did a 20-to-1 stock split. Tesla has split the stock twice in the past 2 years, and it just keeps running up again. So there is a lot of opportunity in the stock market once you understand it. Like I said, you got to first get on one of these platforms that you see down here. Go ahead and click on the link. Don't forget to like and subscribe, but click on the link, sign up for these trading platforms, and go ahead and get yourself ready to start trading some stock, because that's the way that you're going to secure a future for yourself and your family. My personal favorite platform is TD Ameritrade. That's the one I use because it gives me a lot of data. But for a beginner, I would recommend either Webull, Robinhood, which is by far the easiest, or Moo. And all of those you can sign up for down here. For my children, I have stash accounts. We do that automatically every month. You can sign up down there as well. We do that automatically every month, and I don't even think about it. I don't miss the money. It just goes there, and it's for them. When they get to a certain age, they'll have money to do what they want to do with their lives, to get them a start. Don't you wish that your parents had that foresight when you were younger? Bought a couple of shares of Apple, a couple of shares of Google, a couple of shares of Amazon for you. Wouldn't have to have done anything else. So the technology that we use nowadays has turned the stock market into something where the biggest players in the industry pay extreme amounts of money for rent to be close to the New York Stock Exchange or NASDAQ or as close to Wall Street as possible, because then the communication systems that they use may be a millisecond faster than a competitor. And that millisecond, when you're trading hundreds of thousands or millions of shares of stock, could equate to hundreds of thousands and or millions of dollars on a daily basis that could be made or lost. But for our intents and purposes, what you want to do is go ahead, download one of those apps that you see down there, go through the tutorial on the app, and then shoot us some questions. We'll be glad to answer them while we develop our show and show you how to go ahead and trade on those platforms. But go ahead, download, set it up, look at what's happening, get your free stock, be a stock owner, and we'll move on together. How do companies end up on the stock market? The majority of times, companies do what's called an IPO, an initial public offering. So first, you have your little company, it grows to a certain point. Now you want to expand it to maybe a regional or national or global basis, and you need additional revenue. So you do an initial public offering and offer shares of your company to the general public. Usually that's done through an investment bank who handles all of the paperwork and the filings of the SEC and getting you on the exchange and so forth. And then one day you are there on the stock market and your name is on that ticker and you see your numbers going up and down. There's also what's called, lately they've been doing a lot of Spac mergers. Spac, S-P-A-C, is a special purpose acquisition corporation. And a lot of new technology companies are going this route because it's less friction than the IPO route, and they get a lot of backing from intelligent business people who assist them in getting their company into the public eye, into the public domain, and allowing them to garner the revenues that they need in order to increase their business output. So anybody in the public can purchase a share of stock for the company. As the company grows, the shares increase, and then when you see a profit that you feel comfortable with, you're going to want to sell that investment in the marketplace. Now, when there are a lot of people who want to get out of a stock, or one individual who has an immense amount of stock decides to retire, you might see a dip in the stock price with them trying to liquidate their position. So it's a supply and demand issue. If there's a lot of supply, then the price is going to be low. If there's not a lot of supply and there's a lot of demand, then the price is going to go up. It's like old cars. The rarer they get, the more money they're asked for them, because there are less of them on the planet. Fine artwork, one of a kind. You'll never find another one. The value just continues to increase because of the supply, which is minuscule, and the demand that everybody wants. So the stock market works pretty much the same way. You have the shares of all the shares of a particular company are called the company's float. That's the total number of shares that are out there. So as far as the float goes, for instance, if you have 1 million shares of stock, that's your float, and your stock price is selling for $10 a share, then your market capitalization or market cap is $10 million. So that's your market capitalization. That's another term that you should jot down and understand, a company's market cap. Apple is one of the largest companies in the world right now. I think they're a couple of $1 billion. So an increase in the stock price funds research and development, pays dividends, and finances stock buyback programs. Companies like to buy back outstanding stock when they have additional revenues, and hope that the stock price goes up in the future, thereby bringing them more revenues. The the declines in the stock price can be perceived as there's an issue with the company. There are maybe bad news coming out, especially if it's insiders that are selling the stock. So that's another thing that you want to look out for is declines in the stock price. But before jumping ship, it might be just one individual who decides that it's time to get out, and the decline is short-lived, and the stock price shoots back up in the very near history. So you really have to do a lot of research before either buying or selling a stock. There are various factors that affect the stock price. One, the Federal Reserve. The Federal Reserve comes out and says the economy is too hot, they're going to raise interest rates, and the stock market last week immediately took a severe hit. Now, there's also demand. There's changes in leadership that could affect the stock price. You have changes in laws. You know, when marijuana became legal for recreational consumption in some states, the price of marijuana companies started to fly. And then once the hype eased off, the prices declined. So other factors that affect the price of stock are changes in technology, supply chain issues, the cost of raw materials, the cost of labor, market sentiment, and liquidation by whales. Like I said, individuals with giant amounts of stock who now just want to get rid of them. So these are all factors that we have to pay attention to on a daily basis so that you protect your assets and your money against the rug being pulled out from under you while you are trading your stocks. All right? So these factors all have an effect on the perception of the investors, right? And perception is probably 99% of what's going on in the stock market. So essentially, the stock market is a place for individuals to go and buy equity in companies that are publicly traded. And the intention of buying or investing in the company is to make money. Not to say that you own stock in this or that or the other thing. The opportunities are out there to make money. And that is what the stock market is there for. So now you have the basics. You have the basics of what the stock market is, how it was created, and items to look out for that affect the price of the stocks that you are purchasing. So in our next show, we'll probably go over how to make a trade and how to purchase a stock. And maybe we'll jump on TD Ameritrade and we'll show you that platform and how to use it. And I'd also like to show you how to use Robinhood because, like I said, I think that's one of the easiest ones to use. But also go ahead, like and subscribe. Remember to download all of these. Go ahead, sign up, get your free stock, get us some free stock, and get your kids a stash account. Start putting $50 a month in there. Warren Buffett started investing when he was 10 years old from his newspaper money. My kids started before that. So hopefully they can take care of me when I get older. Mash that like and subscribe button. Hit the bell so you get the notifications when we put out a new show, and have a great day. Remember, all we want is less work and more stock. Have a wonderful evening, everybody.